Hello and welcome to our ongoing series of conversations with people that are making a difference with how it is that we live our digital lives. Very fortunate today to catch up with Craig Martin. He's the Managing Director for the Wealth and Lending Practice at J.D. Power. Craig, thank you so much for taking the time to chat with us today.
Well, my pleasure. Thanks for having me today.
Well, so the topic today is really understanding the wealth management environment, Craig, especially in the context of digital transformation. And I'm wondering if you can provide us with your take on the key competitive dynamics that are shaping up and shaking out in the wealth management arena in the context of digital transformation.
Absolutely. It will be my pleasure. And I think the critical piece, when J.D. Power is thinking about the competitive landscape, always comes back to the customer. But there's a reason for that. There's some business dynamics. And as we think about, as companies are making decisions, whether it's investment decisions, new technology purchases, people, systems, processes, they're going to be considering a number of factors. But, from J.D. Power's perspective, what's critical is always thinking about through the customer lens how those investments are going to be received, used, and then how does that play out in business outcomes? Because in the end, the consumer determines whether you're successful or a failure. Their choice of investing with you, working with you, whether it's buying your products, giving you management rights over their funds, et cetera. All those are going to come into play. And so the key to starting any kind of these discussions around digital is really going back to the basics, because oftentimes people get caught up in chasing new technology. And while technology is critical, you really need to understand what's important for the customer, what doesn't change. Because if as you can imagine, technology is changing so fast, there's so many new options, you have to really be grounded in some foundations and stable elements. So that's where we tend to start. And there are 5 universals that we have focused in on that we think are consistent over time. You can go back to them with regular frequency, and it really is crucial and foundational to a great experience and great success long-term in any industry.
And so what would those 5 elements be? Absolutely.
So I think if we look at those, there are the 5 that we focus in on are going to be convenience, and that's really about the concept of efficiency, ease of doing business, low effort. There's a recognition element where companies know you, they appreciate who you are, they're working with you and kind of personalizing to you. A third is going to be advice. And that advice isn't, in wealth management, people always think about a financial advisor, but in many respects, this is recognizing where I need help, what assistance I need, and then addressing those needs in the context that those needs come up. The fourth, and maybe the most important, is trust. And trust can cut both ways, but trust really comes down to belief that promises will be kept. They trust the situation. It's a consistency element. And so you really want to think about trust in a lot of different categories. And I think that's a critical piece. And then finally, value. So what's the perceived value for what I'm paying you? And so that comes in very impactfully in the wealth management space, particularly as we think about what is technology doing for us today, what capabilities are out there, and what kind of services do I get for the fees that I'm paying, and is a critical question as we go forward. So those 5 universals truly, from a customer experience standpoint, are consistent, and they certainly play a big part of the performance of different companies in wealth management space.
And so from an impact analysis, how can those variables be managed to ensure that people in the wealth management business throughout the value chain are able to manage those variables in today's digital environment?
Well, I think what you have to do is really go to the customer and think about how does the customer translate those, or how do they perceive those elements. So, I'll use a simple example from another industry to paint this picture. You think about convenience. And what is convenience? In the past, if you think about the banking sector, a few years back, the height of convenience was an automatic teller machine. otherwise known as an ATM. So the idea that I didn't have to walk into a branch, but I could walk in, give a card to a machine, and it would hand me cash, and even got to the point where I could deposit checks. That was the height of convenience. Now the idea that I even have to leave my home or my desk to deposit a check seems almost silly. So certainly, if you look at it from the customer standpoint, that's convenience. And from a technology standpoint, clearly, the remote deposit capture concept of using your smartphone to deposit a check is dramatically different technology than maybe what you have thought of from an ATM years and years ago. But they all equate to the same concept of convenience. If we think about the wealth management space, there's a number of different examples, but I think particularly around where we are today with mobile and the expectations that particularly the active traders and people who are using self-directed investor types, they're going to have a high expectation for using mobile capabilities. And what we found in our self-directed study this year is that 50% of consumers in that study are using the mobile channel. I think what's concerning right now is that mobile satisfaction is actually much lower than traditional online satisfaction. So in that group, there are high expectations. And, if we look at other sectors, banking and credit card and, mortgage, people who are using mobile are actually more satisfied. And, the fact that the wealth management industry is seeing greater gaps there between the online mobile and the reverse in that less satisfaction with that channel points to some misalignment. What is the customer looking for? What kind of convenience? What are those capabilities? And so I think that DIY customer has fairly high standards, and it's critical that we can invest a lot of money, and the wealth management industry has invested a huge amount into these capabilities, but the fact that the consumer is not responding in as positive manner as we would hope is really important, because that is going to be a point of competition and differentiation going forward, how effective your mobile capabilities are and how effective you can deliver those. And again, the online capability today is continuing to be kind of more beneficial or perceived more positively, points to some need for evaluation and careful consideration. And again, that's convenience. Mobile is convenience. Being at your home, making a trade, or acting, trying to research is probably not what consumers are thinking of. They're at the ball game. They're on their way to work, on the train, what have you. They want to be able to have access and be able to take action anytime, any place using those capabilities.
Very interesting. So clearly a huge evolution in the technology. What do you think about some of these other areas? I'm thinking about artificial intelligence and some of these other digital engagement models that have received such breathless attention over the digital transformation dialogue that's taking place in the financial services industry in general and wealth management in particular.
Yeah, I think those are really important topics, and as you think about it, you always, again, I keep encouraging folks to go back to what I would call the core, which is what does the customer think? So, using something like an artificial intelligence, that encompasses a number of different angles and areas. But if you think about something like recognition, and you know your customer, you understand what they value and how they want to interact, then you can start using those new tools and capabilities like the machine learning and understanding their behaviors, and then delivering communications and services and options and recommendations in alignment with their needs. So the technology is there to deliver that, but it's really critical to understand what does that customer want. If we look at our full-service investor study, if we look at communications and this combination of where do you reach the highest level of satisfaction from an advised client? And what we saw when we do our analysis is that, probably not surprising, the combination of high touch from an advisor, consistent and regular communications, combined with regular communications through digital channels leads to the optimal level of satisfaction. But there are trade-offs that are going to be made. I mean, that's why AI and other areas are so kind of top of mind for so many firms is they're trying to weigh the trade-off decisions that must be made. If I have 100 or 200 clients, the idea that I'm going to be calling them every day, it just doesn't work. I can't. I don't have enough hours in the day. They're not available enough for us to have that level of interaction. So what we see in the data that's very interesting is that as you decrease that level of advisor contact, the right use of digital and kind of new technology capabilities allows us to actually decrease the kind of negative impact. So actually, there's a pretty meaningful decrease when we say you don't have the right level of contact with your advisor, but that is cut in half when you have the right level of digital interaction. So as you increase that digital interaction, it can greatly offset the negative perceptions that customers have, and particularly as you use AI and you learn what the customer wants and how they want it, and the messages are tailored correctly, you really are recognizing them and their needs and their wants, and it delivers a much better experience for the consumer. And really, you can think about, again, making those trade-off decisions. Who are these critical customers? Who are my up-and-coming customers? And really design your contact strategies, your communication plans, and then your corresponding investments in technology to align with those.
Interesting. The wealth management sector is of course a complex one that is made up of several distribution channels. How is this digital transformation scenario playing out in terms of its impact on the different distribution channels that are out there to provide that great variety of, high touch, white glove to, the online, I think you mentioned the do-it-yourself sort of community. What are you seeing from a movement perspective in the distribution channel discussion?
Yeah, and the distribution channels, you are seeing more and more consumers, looking for this kind of blended model. And what we find so often is that, people want to box consumers into and say that's what they want, or they like this channel, or they're going to work with this consumer. And so this kind of goes to this concept of advice. And as you think about, how are you going to advise that consumer? How are you going to develop those relationships? And how do you do that through the various channels and means that are out there? And so, you're thinking about their satisfaction. A young millennial who is early stages needs advice in a certain way. And so at that point, how are you leveraging, they're looking for kind of basic guidance. What's the market about? How do you deliver those education tools? And so, they're looking for that. And these KPIs that we see in these studies actually show the impact of loyalty. So that, one of the challenges so many are struggling with is I've got these consumers, and at this point I want to engage them. They aren't willing to pay for an advisor. So that channel, that distribution network is not a right fit. At the same time, they need that level of advice. So how do you use kind of new capabilities to advise them? And so one of the things we will see is that, developing a strategy to meet people's goals during the onboarding process. That can be done through what we call a kind of a blended environment. So in our do-it-yourself or our self-directed investor study, there's actually two categories. So we have DIY and seeking guidance. So understanding that seeking guidance group that is, potentially working with our wealth management firms that are kind of do-it-yourselfer in general. Those capabilities and making sure those tools and education are there is critical, because that's going to be a differentiator, and that's going to help transition people over their life stages. If I don't have enough funds and financial well-being at this point to be able to pay for a dedicated advisor, I'm still making choices about my relationships early on. And so as we think about what advice do you provide and who is open to that advice, and that's always the funny dynamics of this world, is that those who are able to pay for this, frankly, have probably gotten to a point where they're less concerned about that advice in many respects. They're looking for validation. They're looking for support. Those younger borrowers, often people think of them as unengaged, not looking for information, not looking to talk to experts. And they actually want that, and so our data would point to this need within the marketplace, to have these new channels and new capabilities, and that's where capabilities like robo-advisors come into play, that allow someone to think about their goals and their impacts there, and the advice that can be provided through alternative means, while still developing the relationship that the customer wants, and then can drive towards kind of that value add down the road in a full service investor type of format. And I think that's it's a blended world that we're living in, and we see people even starting to cross over and testing out the waters with robo-advisors and others. But as we evolve, it's understanding kind of what are those needs, what is the advice model, how do we kind of reinforce those capabilities and the value that come through, and deliver the capabilities, at a price point and an investment point that maximizes the business results.
Very interesting. You talked about the demographics on the customer side from both a borrower, from a lending and a wealth management perspective. What about on the supply side? Are you finding that the community, the providers themselves, are embracing these new ways of engaging with both new markets if they're going after the millennials, as well as remaining in touch with the baby boomers and the Generation Xers?
Yeah, I think if you look at the historical trends and where we've seen, the advisors, you've seen an evolution. So many of a few years back, everyone, kind of surmised that maybe the robo-advisors, they've often been termed, we're going to take over, and very clearly that has not happened. I mean, we still see Merrill Lynch, we still see certainly a number of these, traditional state brands and firms providing advice, continuing to manage very large portions of the marketplace. So those haven't gone away, but you're starting to see those kind of robo capabilities being incorporated within business models. And I think probably some of the most obvious ones would be things like Charles Schwab, Vanguard, but certainly all of the major players are starting to embrace this new technology and these new capabilities. Think about it from an advisor standpoint. Mentioned earlier that kind of frequency of contact, the need to really, convenience. And convenience can go both ways. So if you think about it from an advisor standpoint, they want to have a convenient way to communicate consistent with their clients. Technology provides them a way to deliver information. You think about, whether it's video chat, I can do, a face-to-face meeting is something that takes a fair amount of my day to execute. I've got, and if someone's coming to my office, we're going to spend a fair amount of time together, or if I have to go meet my client where they are, certainly travel time and all those other factors. We're now seeing the evolution where people are using technology like, whether it's, assisted chat and other areas, or video conferencing, Skype, et cetera, that allows them to interact, and, they can go from meeting to meeting to meeting, so they can execute a much higher proportion, a higher level of engagement with a higher proportion of their book on a regular basis. At the same time, it allows them to kind of share information and be more flexible and engaged with that consumer than they have been traditionally. So I think you're seeing that. Obviously, there's a demographic shift in the wealth management space, even in business model shifts. I mean, if you start going down the rabbit hole of technology, we've seen, in the RIA space, a major shift in kind of what investments are required to get the technology, software as a service type of avenues, allows people to, change and shift their how they are working and even their business model much more easily than they have before. So the traditional barriers have broken down. And so they can really focus on kind of what is critical to them. I mentioned trust earlier, and I think many times if you look back, people in the business, one of their challenges and why they've kind of moved away from some business models or groups is they felt like they can't continue to execute the level they wanted to. They can't, whether it's limitations or constriction on compliance and legal, but or it's requirements to what customers can you work with, what kind of size of portfolio do you need to keep, how big a client, how much wealth do they have to have before you can spend time with them. So from their standpoint, their delivery of trust, keeping the promises. If they started working with someone years ago, their ability to stay with that customer can be compromised. And so they're very much committed to that concept. If we look at what drives, from a customer's vantage point, what drives their satisfaction, what's really impactful, a lot of that is around contact. And so I mentioned before, kind of these new methods of contact allow for greater flexibility, allow these wealth management folks, the advisors, to increase their effectiveness in delivering that trust. I can communicate with you. Luckily, we've had some very positive trends in the marketplace, but if you ask most wealth management folks, the time when financial advisors truly earn their keep is during downtimes. It's helping to provide that advisor perspective to calm fears, to communicate what's going on, to help folks stay the course, understand their goals, their strategy, and we see all of those elements are critical. Timely response back, answer questions on the same day, returning calls the same day. That will go up dramatically when the market starts to fall. The importance of that, because I'm making that decision, hey, the market's down 500 points, should I be selling? That's a critical time, and your ability to potentially use technology to go out and quickly send a message reassuring consumers, an automated text, an automated email that goes out to consumers, a quick phone call to your key clients, you can now communicate more effectively, and proactively, even when someone maybe is in the system trying to click and change, their choices on their portfolio. You could actually advise them and deliver messages in a timely manner that calm the fears and really provide that trust and advice that they need.
Interesting. Well, when things go down particularly dramatically, there's usually some sort of regulatory action that's likely to happen. You've talked about new technologies, new asset classes, new demographic behaviors. How are you seeing the regulatory environment factoring into this discussion in terms of managing uncertainty or navigating the changes that could sometimes come in an unexpected manner?
I think this, the age-old kind of wisdom is that no one wins in being compliant with regulations. That's not a winning combination. I'm going to be the best at being compliant, but it's a part of doing business. If you're not compliant, you may not be in business long term, and certainly that's clear. If you think about a recent example in the wealth management space that's really had a huge influence, and that would be the DOL regulatory kind of guidance that came out and didn't end up going into effect, but has truly kind of played a critical part going into this time. And I think what we're seeing is that I just saw an article that came out, and it was in Think Advisor referencing Charles Schwab, and he lamented the image of advisors as used car salesmen. And the DOL rule focuses on kind of fiduciary responsibility and kind of what is the fees environment. And I think this really goes back to as you think about regulatory, it was all driven by, do customers understand the fees? Is it clear? Are they, are they above board? And what we see is that, in our data is it's very clear that regardless of kind of the regulatory piece of this, that consistency in communication, the clarity around fees is critical. And so, again, you can argue around which regulation's coming next and try to chase that down, and often that's much like trying to chase the next great technology. It's often a fool's effort because there's always going to be a next regulation. There's going to be a new, someone new in office at some point in time, and they're going to have a different viewpoint, and they're going to make different changes. So getting back to what does the customer want, and if you are consistent and you know your business and you know what's critical to your consumers and to your staff, you can really effectively address this. And what I find interesting, is we look at our self-directed study, and there's still a very clear lack of clarity for many consumers. So, more than half indicate they didn't know the types of fees they paid, or the type of fees that they know the type of fees, but they don't know the amounts. So if you think about, what's the value exchange, and the regulators are trying to force feed that component to it, is the customer should understand the value prop. They should understand what they're paying for and what are they getting for that. As you look at what's going on there, those who are ahead of that game, who are recognizing what the customer is demanding and wanting, and who are more effective at delivering that, they don't have to worry as much. Obviously, you have to be compliant, and that's an element you cannot get away from. But if you think from a customer standpoint, what does the regulations mean for them? How does that play out in the day-to-day relationship with the consumer? And how do you stay ahead of that? Because too often people get caught up in chasing and kind of executing. And when that comes out to the customer, if your financial advisor is basically saying, I don't really want to tell you this and I don't want to talk to you about this, but the regulators are making me, versus my goal is to be as open and transparent with you as possible and to make sure you understand what's going on, and that's why I communicate these things. You might be doing the exact same thing for the exact same reason, but the message that comes out to the consumer and the impact on the relationship and long-term health and kind of value of the relationship can be dramatically changed. And again, that's not, you're going to have to deal with regulations, and it's always going to be there. Compliance is part of the financial services world and will always be, as far as anyone knows. But I think that's critical to be able to come back to that consistently. And again, foundationally, it's a value proposition. What do you get out of this relationship? Am I delivering honest answers? Do you trust me? Then at that point, the government's actions have limited impact on the customer's perceptions.
Outstanding. What a wonderful discussion, and helping us understand these key factors that I think we're going to have to return to: the technology issues, the changing nature of distribution channels, the shifting demographics, and how we deal with asset classes and these regulatory changes. I think today we've laid the foundation for hopefully an ongoing discussion over the next weeks and months. Thank you so much for helping J.D. Power start this very important discussion, Craig, and I look forward to reaching out to you and your colleagues again to take this to the next level.
Wonderful. Thank you so much for your time today.
And we're out. Excellent. All right. Did you feel like you had the opportunity to make the key points that you wanted to make?
Yeah. I think that definitely worked.